Hello, welcome to the Mutual Fund Show. My name is Neeraj China. Over the next 30 minutes, we'll talk all about mutual fund queries. Now, Indian mutual funds have been in thick of news for the last few months. Standstill agreement entered by some fund houses with SL Group, the IL&FS crisis, subsequent moves made by SEBI to put in stronger checks and balances. We've been through all of this. Some of the changes are reflecting in flows over the last few months as well. But the bigger question is whether some of the lessons have been learned by both fund managers and investors alike. So we thought of the 5 key things that we would want as investors to know from our advisors, and those are the questions that they are putting to our 2 mutual fund advisors who join in today and who will have to answer these very questions from investors almost every single day for the last few months. Suresh, Sadagopan, Vishal, founder of Ladder 7 Financial Advisories, and Vishal Doshi, partner at Alpha Investment Services in our studios. Gentlemen, both of you, thank you so much for joining in.
To be
5 key questions that stem. By the way, right now, since we're on the topic, a first 1-minute opener with both of you. Have been the last 1 month, have you recommended your clients to start SIPs into small cap and mid cap funds? 1 minute, Suresh.
As a general rule, we have not been recommending small caps at all.
Oh, okay.
Okay, as a general rule. Mid caps to people who have a fairly aggressive risk profile, we do recommend mid caps. As far as small cap participation, I would prefer through multi caps.
Okay.
So that's what we are doing. So really aggressive clients who have a long horizon of earnings. So we will probably give an exposure through mid caps and maybe multi caps. Not really small caps. Small caps, we are very, very careful about that.
Okay, so you haven't done that. Vishal, have you done that?
I have just started recommending small caps to my clients because I think there's a lot of decimation in the NAVs and the prices of stocks have also gone down significantly. So I think some incremental allocation can be done to small caps now, but with a view of at least 5 to 7 years. Of course, clients have to keep in mind.
Okay, so that was off topic. Now let's talk about the 4 or 5 things that really we wanted to ask you about. The first one was, of course, these changes in the liquid fund regulations, apparently effective from September. Now, the reason why I brought this up is because when the Amphi data came out, the 2 CEOs who spoke to us, which is Edelweiss as well as Sundaram Mutual, said that these we saw that remarkable uptick in liquid fund inflows, right, for the month gone by. And when we were talking about that, they said that some of it could also have to do with the regulations. But the idea that we wanted to present to our viewers is that what these regulations are and what do these changes mean for people who want to invest into liquid funds or are already invested in liquids. Now, whether they are effective from September, whether they get effective later on is separate altogether. Correct. But what are these regulations and what's the impact? Suresh, if I can start off with you.
Yeah. So one of the things that they are saying now is that whatever underlying investments are there in a liquid fund, they want to mark it to market. So once upon a time, when there is a credit event, what happens is you immediately know what is the price of that particular underlying investment. And it will reflect in the NAV. In the previous regime, what used to happen is up to 60 days papers, they used to amortize. So whatever was the present price and whatever was the future price, so on for the entire period, they will amortize the rates. So the exact price will not be reflected. So the change which they have made currently is a good change. It will actually reflect the true value of the underlying securities. And yeah, it can become slightly more volatile, but it will also be a true reflection of what is the underlying investment value.
Okay.
That is point number 1. The second thing which is also happening is that they are also asking them to keep about 20% in liquid or near liquid instruments. So that means that even in a situation where there is a credit event, there is enough liquidity in the system. So which is a very, very positive step. Yeah, this can have again an impact in terms of the returns. Yeah, returns can slightly go down.
That's what I was wondering, yeah.
Returns can slightly go down, but again, you're not investing in a liquid fund basically to make huge humongous returns. What you are really truly interested is the security should be, the amount that you're putting in, that has to be safe. So that's the primary outlook. There is one more. You want to ask him or should I?
No. Completely fine, Vishal. I don't know if your thoughts change, but or differ very much from Suresh. But do you think it will have a material impact on the returns? They would have some impact. How large the impact could be? And is there something else that you want to add? Of course.
I think as of now, if you see, many liquid funds are already holding 20% in near liquid assets, so to speak, like T-bills, etc. So that may not be such a big impact, but the main point is this kind of regulatory changes are going to make the liquid funds much more safer. Plus, it is going to reflect the true picture of the scheme portfolio. So it becomes the comparison between various liquid funds will become now easier. So that I think is the real thing, and these regulatory changes should be welcomed by investors because it is in their safety. It is for their safety.
Okay, so you'd be happy with the changes that have been proposed.
Yeah,
You want to add something to that?
I mean, I'm quite happy with that. I only said that there can be an impact on the returns and stuff like that. But I think in the overall scheme of things, I think from the investor point of view, that's a welcome position.
Okay. The next big thing, and I think a lot of people are talking about it, Vishal, I want to start off with you on this one,
Sure.
is this small sets of repayments that we are now starting to see by some of the groups which are in trouble. SL Group made that larger one. DHFL apparently repaid some monies to the, actually not apparently, they did repay some monies to DSP as well. We are hearing of stake sales from the Reliance Capital stable as well. They are selling off that stake in Reliance Nippon Asset Management. And so all of these are linking people to, or making people believe that the kind of stress that existed in this credit risk fund and this whole system might be easing a little bit. Now my question is, does this make credit risk funds an attractive buying opportunity for the investor who is not necessarily very risk averse?
Yeah, so I think now there are two things to this question. One is there are two sets of investors. One is conservative and one is aggressive. So as you rightly pointed out, aggressive investors can look at credit risk funds now, because I think even last time on the show I had mentioned that the difference between the repo rate and the YTMs of these accrual funds, I think that difference is now very large, and credit risk funds have now become attractive for aggressive investors. So people who understand the kind of risk which is there in these funds, I think they can start looking at such funds. But investors who are conservative, who are not willing to take risk, I think they should still stay with the liquids and the ultra short terms of this world. So they should not venture into such kind of funds.
Okay, you don't quite want to bifurcate it in a way that if you are indeed a risk taker, then why take a risk in non-equity funds? Might as well take the risk in equity funds.
No, but then equities obviously are a different asset class, and the risk profile over there is completely different.
Okay.
So I don't think so both of them would be comparable, so to speak, because in equities we are there for multi-year investments. We are looking at 15-20% at least. But credit risk funds, we are there for probably double-digit kind of returns.
Okay.
So which is what the YTMs are offering right now. So I think aggressive investors with a higher risk profile can look at this.
Selectively, such options are available right now as well. Okay,
yes.
Suresh, you differ? And it's okay to differ, by the way.
No, absolutely fine. I mean, I have no point of difference from what he's saying. The only thing is, see, whether it is DHFL or SL papers or Reliance papers, it is not only credit risk funds which are having those papers.
Sure.
So, I mean, these papers have been present across the board in funds which are supposedly, good funds, because DHFL at one point in time was a AAA rated entity. So you would find that across the board. So there is a bit of trepidation among the investors that, what will happen to my debt fund? So that concern is there. So a lot of people have also told me that, probably we should have invested maybe in a simple bank fixed deposit. Maybe from a post-tax return point of view, it may be somewhat less, but I will not have these kind of palpitations at every point. So, coming back to your question, so when these people are doing their best and they are paying back something, so there is some expectation that things will get sorted out now. People are waiting on the sidelines. I mean, as far as we are concerned, we are telling the investors that it will take some time for the entire thing to blow over, but they are doing their best to sort out the problem, each one of those promoters.
But you're not trying to tell your clients to take advantage of this situation, is my question.
I would be cautious on this, because see, at this point in time, these people are doing their best. I entirely appreciate that, whether it is SL or whether it is DHFL, all these people are doing their best. But the crisis, in my opinion, is slightly deep and slightly beyond the promoters' level. So it's structural. There are deep problems. So how the exact problem will unfold in future, we don't know. We really don't know. So while I'm cautiously optimistic that these people are doing their best, I wouldn't really go for credit risk fund and those kind of things. I mean, we never went for credit risk fund in the last maybe 4 or 5 years.
And you're still not going for it?
So we are still not going for it. I mean, we are going for safety.
Safety. Vishal, just one question. for the aggressive investor is, if you have analyzed the credit risk funds, is there one which is your favorite right now for somebody who wants to make a fresh investment? A standard disclaimer that the risk is entirely off the person who is investing in it, because you do not know the person who is buying it on what portfolio he has. But for your clients, if you're comfortable investing one credit risk fund, which is it and why?
I'm looking at ICICI credit fund. So I think the portfolio over there comprises of AA and single A securities. So obviously it has that kind of risk. So investors who understand the risk with such rated papers, only they should go in with this.
Okay, fair disclaimer. And viewers, remember, please do your own due diligence. If you have an advisor, please consult an advisor before you try and think about this. Is just to give you an idea of what Vishal, who is our guest, believes in terms of which credit risk fund might be a probable investment opportunity. Let's move on to the next one. There was a newspaper article which spoke about how the PMO might actually relook at some of the PSU ETFs, because they apparently got advice from some market participants that this is leading to crowding out, and therefore the prices are getting damaged, and we've seen evidence of that. Now, my question is, if indeed, Suresh, I'll start with you on this one, if indeed there is a relook at the quantum of PSU ETFs and the paper coming out, etc., and all of that, what kind of bearing would it have on from a mutual fund perspective? I know that some stocks will do well. My question is, if you've looked at mutual fund portfolios or ETF portfolios, etc., are there any investment opportunities thereof? Let's not preempt. Let's wait for this event to happen. But once the event happens, are there some funds that people should keep in mind? What's the impact of this move?
I don't think, as far as the CPSE space is concerned, I think it's a pretty diverse area. You have companies from defense to, power sector to everything, oil sector. So it can be any of those companies which are ultimately going to be disinvested as per the government's intention and mandate. So, which sectors will do well, and which of those companies and sectors the fund manager will ultimately want to have in their portfolio is a matter which is left to the fund manager at that point to decide. So, government wants to liquidate the thing for their own, they have their reasons to liquidate. Okay, so they have this mandate of liquidating more than 1 lakh crores in this year. So, from their point of view, CPSE is a good idea. At this point in time, markets are not doing well, and they also don't want this crowding out to happen. So, at this point, there is a rethink on that. But purely from a mutual fund perspective, I don't think, they will be looking at it not from the government company or private company. I think they'll be looking purely on merits. And if those companies score on merit, they will look at it. Otherwise, they will not look at it at all.
Sure. The reason I really wanted to bring this up is because we've seen that there's been a substantial price damage when the announcements of these things happen, and as a result of which maybe some market participants did make this, had this conversation apparently that let's not, do this. So if indeed that relook happens, then the price damage on some of these larger PSUs might not be as large, and therefore I was wondering if some PSU stock dominated funds, ETFs, etc. would benefit. Is there merit in thinking of those lines? Because we got a couple of queries regarding that.
Okay. So there are really not many funds which are focused on PSU stocks as such. So the government's favorite vehicle is the CPSE ETF and probably the Bharat 22 ETF. But again, that has some private names in it. So pure play PSU investment is only the CPSE ETF. So if you think from the government's perspective, what the government is trying to think in this, Neeraj, I think up till now they have been continuously selling their stakes via the CPSE ETF route. But that is actually putting a lot of pressure on these stocks, and in the end the investors' wealth is getting eroded by this method. So ideally they should be going for strategic stake sales. I think finally now they have said that they have identified some 16 companies where they want to do this. So even if you look at past history also, I think the last time when the government did strategic stake sales was probably in 1999-2004 period, when I think quite a few names like BSNL, IPCL and even Hindustan Zinc was getting sold to private players. And the kind of wealth some of these stocks have made for investors has been very good. So Hindustan Zinc has been still listed. So I think I remember the stake sale happened when the market cap for Hindustan Zinc was just 1700 crores. Right now it is over 90,000 crores. So investors who stayed on with it have clearly benefited. So even in the case of IPCL, now it is not listed, but when the stake sale happened, it happened at a significant premium to the prevailing market price. So I think the price was around 100 at those point in time, and the stake sale happened at around 230 rupees to Reliance. So the government clearly got a huge premium over the prevailing market price, and probably that is the right way to sell these stakes. So let's hope the government starts thinking on those lines.
Let's see, in the crowding out, maybe from a minority shareholder's perspective, if not a mutual fund investor's perspective, it might be beneficial as well. The next piece is some fund manager changes that have happened. Now, these keep on happening, and I completely agree. But again, a couple of, in fact, 2 or 3 messages to me about UTI AMC, some change in fund managers for some of the schemes. You guys would know better about it. But
Right.
Vishal, start off with you. Is it something that should worry current investors of some of these schemes at UTI?
I don't think so, honestly. I think whenever a fund manager exit happens, I think investors have to ask a couple of questions. Whether they should stop their SIPs, or whether they should stop doing incremental investment in those schemes, or whether they should pull out the existing money. So clearly the second option is out of the table, and they should not do any such kind of knee-jerk reaction. So investors can probably then see how the new fund manager, what is his pedigree, how many years of experience he has. So clearly in the case of UTI, the new fund manager, Ankit Agarwal, has got many years of experience with him. Previously he was, I think, fund manager with Centrum Broking's PMS. In fact, I think he was ranked number 1 in the Asia Money polls as well, as the best fund manager in the discretionary PMS space. So he's got some pedigree with him, and investors should not behave in a knee-jerk kind of reaction and stop investing in such schemes where the fund manager exits have happened. So we can also look at other AMCs where fund manager exits have happened in the past, like IDFC, Axis, and DSP. All of these fund houses have seen a change in the top management in the fund management space. So there have been mixed results, but just to immediately react and stop making incremental investments is not the right way for investors.
Okay. So no cause for worry for either existing or potential investors
Absolutely.
of UTI AMC.
Yes.
Okay. Suresh, your views?
Yeah, largely I concur with his views. I mean, what has happened regarding various fund houses when the fund managers have changed, I mean, there are mixed results. One of the learnings as far as the fund houses are concerned is that now many of the fund houses have put a robust process around this. So it is not one superstar fund manager and he does what he wants, or he or she does what she wants. So it's no longer the case, and there is a process around it, and there is an analyst team around it. They have a meeting of what candidate should go in. They have a clear-cut process of when they should exit, at what point, when they hit what numbers they should exit. So those things are there, and so in a lot of cases the fund manager exit itself may not be such a significant event. They have made it that way. So I believe many of the fund houses are following that path, and for that reason one should not worry. I mean, all the things which Vishal said are all valid. I mean, you have to look at the fund manager, the pedigree. The fund manager does make a difference, but I think it is not something which one has to worry so much. As long as the fund house also has this thing of following the objective of the fund and the processes. So if they are doing that, I think there is not much to worry.
Okay, generally, irrespective of UTI, any other fund, you guys would hold a similar view almost, that it is not, at least in these cases, it's not a worry.
Yeah, what I've heard some of the fund houses say, I mean, Sundaram has been talking about having a process, and it is not a fund manager centric thing. It's always a process that they have. So similarly, some of the other fund houses have very clearly, explicitly, they have certain processes. So that's a source of comfort for advisors like us, because if it is going to be fund manager driven, I mean, you never know when the fund manager will exit. So
Sure.
I mean, it's going to be a source of worry all the time.
Okay.
So I think fund houses have learned this, and I think many of them have put that process in place. I think we should not worry too much on that. Of course, at the same time, look at who is the person who is taking over, and till the time that person puts in some amount of time in the fund, keep monitoring.
Sure. Okay. Keep monitoring. Well, that and viewers, I think that you should do irrespective of whatever else. I think Suresh is just being kind out here, but yeah, I think in his previous shows as well, he's advised us so well about how monitoring your investments almost every single time, irrespective of whether you have an advisor or no, is a very important thing. If you have an advisor, it probably only eases the things. The final question on the show today, and the final segment is, we couldn't have done it without gold, could we have? I mean, 40,000 Indians are a richer lot, so everybody's happy. But there is a whole new age of people, startup investors or investors who just started investing, who don't want to buy the physical gold.
Yeah.
And some of them are wondering, I was at an event wherein I met some 7-8 people between age of 21 and 30. And some of them, to my surprise, didn't even know that you can buy paper gold, in which shape and form. There's this government process also available, and there are funds and there are ETFs, etc. So I want to ask this question to you. Somebody wants to buy paper gold. What is the best way to do it? Forget the timing. We can all get the timing wrong. But if somebody is convinced that I want to buy gold, irrespective of what happens to the prices in the next 12 months, what is the most effective non-physical way of doing it?
Sure.
So if I were to say the best way today will be the sovereign gold bond. The reason today for the sovereign gold bond is that the costs are negligible. You have to hold it for 8 years. At the end of it, there is no capital gain. Every year that you are holding that particular sovereign gold bond, you are also going to get 2.5% return. So on one hand, there is no capital gain. You are going to track the price of gold, and you are also going to get 2.5% over and above that as a return. So in my opinion, as compared to index fund, as compared to ETFs or any other instrument today, I think that gives the best bang for the buck.
Okay. Is there a mutual fund option to do as well? And what would be the difference there? Say, for example, a gold fund. And then I'll come to Vishal, of course.
Yeah. So as far as the mutual funds are concerned, you definitely have a gold ETF and a gold index fund around that, wrapped around that. So in the case of a gold ETF, it does track the price of the gold, the physical gold. You don't have to hold physical gold. So that's the good part. But in the case of an ETF, all you will get, after the charges, is tracking the price of gold. So there is always a bit of tracking error because of, number one, the charges itself. The charges may be as low as maybe 0.3 to 0.5, but still that tracking error is there. If you compare that with sovereign gold bond, you are going to get that 2.5% more, and there is no capital gain at the end of the tenure. So now if you look at index funds, there are clear negatives as far as ETFs are concerned. You will have to have a demat account. You will have to sell the gold, buy the gold on the exchange. So, and you may not probably be able to do SIP the way you normally do in a mutual fund. So that is why a gold index fund is also there, which is basically investing into gold ETF. So there, the counterparty is the mutual fund. So liquidity is assured. So in the case of ETF, one cannot really say that. So here the liquidity is assured, and here you can start a SIP. Of whatever amount you want. But yeah, the negative point is that it is wrapped around an ETF. So the ETF charges will be there, and there will be something over and above that. So as compared to a sovereign gold bond, this is not such a great option. But for people who are already doing mutual fund investment and they don't want to get into some other instrument, and they want to keep it pretty simple, I think I will recommend index fund. Gold.
Okay. So gold index fund over a gold ETF. Yeah. Do you concur with that view? And what is the best option in which is available?
Yeah, so I think actually there are three options, as you rightly pointed out. One is the sovereign gold bonds which the government has been issuing.
And you think that's the best too?
That is a good option, but then all the three options have some of the other issues and some advantages with them. Like the SGBs are good because they give you, it is obviously government backed, plus they give you 2.5% interest rate, plus there is no capital gain. So these are the good points. On the other side, there is no liquidity. That is a problem. Otherwise, you can go to gold ETFs. Again, now gold ETFs provide some liquidity, but then the issue is there are some 2-3 kinds of charges which you have to bear, which is the expense ratios, obviously, plus some demat charges and the brokerage, and you have to open a demat account, etc. So to manage those things. But then it offers you liquidity. So having said that, if you look at the last 6 months, I think gold has added something like 20-21%. So gold ETFs have nearly tracked those kind of returns, and then they have given the gold returns to the investors. But the gold funds have actually lagged behind. So I think there is a gap of around 3-4%.
Why so?
I'm not so sure, probably because of the expense ratios. Because I think, as Suresh rightly pointed out, there are the expense ratio increases in a gold fund. So these are the same AMCs offering gold ETFs as well as gold funds, and the difference is 3-4%. So if you want to do SIPs, etc., then gold funds are probably a better option because they give you that kind of facility which is not available in the sovereign gold bond as well as the gold ETF option.
Yeah, unless you do the SIP yourself,
Absolutely.
which is the first of everyone.
Yeah, which is obvious.
Just wondering, just to follow up, I haven't studied a gold fund, but would any of the Indian gold funds have investments not just in a gold ETF but also in gold mining companies? I think globally there's been a trend, and in some of the gold funds also have investments in gold mining company stocks. Now, is that option open in India, or are these performances not related to that?
The one that we are talking about are clear-cut. They are investing in gold.
Yes.
Okay.
So, there are some gold mining funds, but that's a different kind
category
of,
altogether.
Yeah, different category altogether.
Okay.
Yes. So there are some natural resources fund as well, where gold is a part of those funds. And there are some specific gold mining funds also, but then that's a different
breed
ballgame,
altogether.
Absolutely.
Okay. Great. Gentlemen, take a moment to thank you for joining on the show today and giving us your thoughts. We're out of time completely. I know there were some queries regards to from one gentleman about what's the best way to plan your retirement. Now, I would urge you, sir, to watch next week's show because we're talking about how to analyze a particular mutual fund portfolio. And in that, we'll talk about what should somebody who's already retired, how should he build or analyze his or her own portfolio. So that's something that's coming up next week. But for this week, we'll have to call it a day. Thank you so much for joining in, gentlemen. And viewers, thanks for tuning in to this leg of the Mutual Fund Show.